Okay. I'm gonna walk you through why basically I'd like to take a long position in the oil markets, and we will talk about whether it's crude oil or Brent crude or New York crude. We will talk about all of that, but the main topic that we want to discuss today is that I'm trying to explain why I think being long in oil is actually might turn out to be a good trade. And we will go through all of these things that you'll see on the screen as the reason why I would like to do that. And it's, you'll find out soon enough that it's not it is actually a bet on direction, but it's mostly a bet on how fast can we open up this strait. Now, before we get to all of these things that you see on this screen, we will get back to this. Let's take a look at the price of oil. This is, crude oil, the WTI, actually. This is WTI. So as you can see, the price of WTI oil is around $87 right now. And you can see there is a lot of volatility. The war started and just went up straight, and then, oh, we're going to get a deal. It came down. Oh, we're not going to get a deal. Oh, it's go up. Deal, no deal, deal, no deal, deal. And the last part was actually, that came out a few days ago, that it seems that there is going to be a deal, an agreement of some sort between US and Iran. It's going to be a 60-day of ceasefire and then talk about the nuclear deal. But while that is going on, the Strait of Hormuz is going to be opened up. So a lot of things that nobody knows yet. As of the taping of this, there is no agreement from the US side. So we'll have to wait and see. But that's not the point. The point is something else, that we are going to assume, as we will walk through all these slides, what I'm trying to say is that even if we assume that those things that they're saying, let's say it happens, let's say those agreements actually happen, still, I think where the price of oil is priced is kind of wrong. So we'll get to that. Now, as you can see, when we're talking about the oil futures, we have different months, different contract months, right? So this is like the June contract, and next month July contract. So as you can see here, we have the December contract, and it's priced as $78, which is, again, I think it's too low, because everybody's thinking that everything will go back to normal pretty soon. We'll get to that. Now let's take a look at the Brent chart also. So Brent, traditionally Brent has like a premium over WTI, and it is at $91, and that premium has actually shrunk. And this is actually, I think, is much more interesting than WTI. And again, I'll get to it. So the thing that makes it actually, this trade makes it work, is this shape that you see here. As you can see, it's like in a backwardation kind of shape, and this is called the futures forward curve, right? So in a normal kind of curve, you see it this way. So it's going up, which is called contango. But now we have a backwardation. Meaning that the prices right now, whenever we see a backwardation in the forward curve, which again, a lot of people, even knowledgeable people, which surprises me, get this wrong, that they think the forward curve is like a forecast of where the price of oil will be like a few months from now, which is totally wrong. All that is saying that, for example, the contract that we are talking about, June, is priced at $87. July is at 85. I'm just eyeballing it. 85. Then I don't know. Let's say August, September, December. So as we go on, the price drops. And all this is saying is that there is a stress in the price of oil right now. Something caused the stress. We know it's the war, and it's causing people to pay a premium for whatever the oil that is going to be delivered earlier, compared to those that are going to be delivered few months later. And some people, because again, this shows that the price of December is, like we saw, is around $78. They're saying that, okay, so the forward curve is predicting that, in few months, the whole thing is going to be, back to normal, and the price of oil is going to come down. But no, this is saying, again, is saying that, okay, we are willing to pay a premium for the oil that is being delivered earliest. And let's not forget, this is a benchmark, right? In the middle of the war, we saw that, for example, the oil that was the physical oil that was for delivery in Oman or in Dubai, it actually got to close to even $200 at some point, right? Whereas the futures price never actually got there. So, again, this is something that is actually the base of the trade, because I think this price, that is priced for December, is too low, and I think it should be higher. So we'll talk about that. And another way of, showing this futures curve, I think this is more helpful than that one. That was a bit hard to see. So as you can see, this is, this is like an example of the chart that actually happened. At some point the price was even above $110. So all this is saying is that there is a physical scarcity premium that we are willing to pay, because we know there is a war and there is not enough oil, so we are willing to pay more for that, right? But again, this part, September to December, is going to be our target, which I think it's mispriced, because again, it's too low, and the reality of the situation has to be caught up with the physical barrels. The reality of the physical barrels has to be caught up with the realities of the futures market, and those prices have to be somehow pushed up. Again, that's my thesis, which we will get to later. So let's get back to this. This is the Strait of Hormuz. I think most people didn't even know about this, location, and now it's everywhere. Everywhere there is Strait of Hormuz. Okay. Anyway, this is the Strait of Hormuz, right? Now, my problem with what is going on, which is pushing the oil prices down recently, is that we see from tweets, or let's call them posts, that Trump puts up on his Truth Social, saying that if when the war ends, the oil prices are gonna come crushing down to way before the war, and I don't know, this thing will very fast go back to normal. So these are the parts that I think it's kind of misleading, because we know, first of all, that still there is no agreement, but let's assume there is an agreement. Now, this is the strait that before the war, about 20 million barrels of oil was, flowing through, right? Then it got shut down. So what did they do? They had to, draw from the storages and do a lot of gymnastics to absorb some of this, to take some of it from other places to take to other places. So they withdraw from their the strategic storages, and we will talk about that. Is also part of it. That is also being withdrawn at a pace that is hard to get back to the normal phases easily. But the other thing that people are arguing is that the Strait of Hormuz is closed, but we know that Saudi Arabia has a west-east pipeline that is going to bypass the Strait of Hormuz and goes to the Red Sea, or UAE is also doing the same thing through Fujairah and these are the things that in a good day. This is something that we know from Saudi Arabia, that in a good day from the Red Sea, maybe you can get about 7 million barrels, right? Something like that. And then from UAE, about 1.8 million. And about UAE also, this is something that this pipeline is under construction. So 50% of it is done, but another 50% is like this is for 2027 to be completed, right? So there's a lot of things going on, and also some people are saying that yeah, but the other side of the Strait, from Iraq, we see that they are going to have a pipeline from the north. Yeah, but again, all of these things hasn't happened yet, and again, all of these things require a lot of infrastructure to be able to complete it so that you can utilize it to the maximum, right? And again, my argument is not it's not that it's not going to happen. It will happen at some point, but my argument is that it's not going to happen as fast as they say. That's why I see the opportunity in the forward curve to go long those oil contracts. So this is, and another thing that a lot of people forget is that during this war, a lot of infrastructure got destroyed, got bombed out, from pipelines to many other things, right? So those also have to be rebuilt, and we know that in Iran itself, in UAE, in Oman, in everywhere, there was because they were what do you say, they were taking all this oil out of the ground, but they couldn't actually take it anywhere. So the storages that they had, to put up all this oil got filled up. So there were nowhere else to put the oil. So when you get to that situation, what do you got to do? You got to shut down the wells, right? You got to stop pumping, because where are you going to put all those oils? And if you can remember, it was like about a month ago that Trump said that, I don't know, Iran has 3 days until the pipelines will explode, something like that, which it's a month out, but anyway. So all of these things, when you combine it all together, my understanding is that this will take a way longer than they say to get back to normal, right? So again, this is something that I have asked Gemini to create a chart for me. So from UAE, the Fujairah route, we see about 1.8 million. From the Saudi east-west pipeline, we can see about 7 million, which is good numbers. But again, when you compare it to the 20 million barrels of oil that was pre-war, that was going in and out easily, and during this time, when we even adjust for the oil that was taken out from the storages and then taken from other places to other places, still about 10 million barrels of oil was destroyed, and couldn't get out. When you compare it to the pre-war situation. So this will take a long time. And again, when we are talking about Iraq, Syria route, this UAE Fujairah route, these are all massive, complex logistical problems that, again, my argument, again, is not that is not going to happen. Again, my argument is for the timeline, right? So, another thing that we should, let me go back to this, the Strait. Yeah. So the ships going in and out of the Strait, right? So when you see the headline that they say the Strait is closed, right? It's not like they will come and put something in the middle of the Strait and then close it up. No, it's not like that. It's just that any threats of a missile, a bomb flying around, these ships are not going to want to go through it. So, there was a point that I remember that Trump keep saying that, the ships have to have some courage to go through, blah, blah, blah. Another problem is that with this 60-day ceasefire, if it goes through, is that that's not enough, because nobody can unilaterally open the Strait of Hormuz. Iran cannot do it. U.S. cannot do it. So this has to be, all the. We also have Israel, by the way. Let's not forget that. So they all have to agree that they are, there is some sort of a coordination. Otherwise, the ship owner who wants to go through it, they have to decide, am I willing to take that risk? I mean, everybody's now aware of it, that Iran and US have been in the middle of negotiations a few times, and then the war broke out. So, I mean, can you really trust them when they say everything is calm and then go through? So it's at the end of the day, the ship owners, first of all, have to be willing to go through the strait. And on top of that, the insurers, whoever is going to provide the insurance, have to provide the insurance, first of all, and then second of all, the amount that they're going to charge as the insurance has to be something that, again, the ship owner and whatever they're carrying is going to be like, okay, it's worth it to go through, right? So these are all different playing parts that you have to consider when you're thinking about, should the oil price in December be around $78 or should it be higher? You know, these are all the things that we have to go through to get to that conclusion. So again, because of all these reasons that I just stated, and in all of these conversations, in all these arguments, I'm assuming, let's say, whatever agreement that they come up with, they stick to it. Let's say they do that. Even if they do that, as you can see, this is a narrow pathway. There is a flow problem. There is a flow problem. That means if you have all the oil in the world, this is this narrow pathway that it has to go through. So it can't go through it all at once, right? And again, it's not about, if you have seen those satellite images of the maritime satellite images of the ships that are trapped basically, in and around the Strait of Hormuz, you see, it's not about only getting them out of the strait. It's about making it that normal that when they get out, they also want to come back in, then again get out, come back in. So that defines normal. To me, that's what normal is. Not that, because to me right now, most of the things that I think they're going through is mostly because to get all the ships that are stuck in here out. So they're not thinking that far ahead, to be honest with you. That's my assessment. And that's why I say that's a like a good probably opportunity. That's a mispriced, at least for when you talk about the September contract, the December contract. I think those contracts are a bit mispriced, and we will go through why I prefer Brent in this situation over WTI, because we know that the U.S. actually, when they did that, they actually got a lot of demand for their own oil. A lot of ships from Japan, other places came, and they started loading barrels from U.S. and also the Venezuelan oil is got, which is again another misunderstanding. The type of crude that Venezuela has, it's very different than the type of crude that you find in the Middle East. I mean, that's like a heavy crude, which is difficult to process, to refine. So again, it's like apples and oranges, very different. So and we know that in most part of Asia and even in Europe, we know that they are hitting tank bottom, meaning that the storage, the amount that they have had reserved to satisfy the demand is drying up. So again, as we get to that, I think it was Jeff Curry who said that. I think the Chevron CEO also repeated that on some occasion. But Jeff Curry was the one that was very vocal on this, that there is a difference between deficit and then there is a shortage. So right now we are in a deficit kind of a situation in terms of oil, right? But once we hit tank bottom in terms of the storages, then you will get to that shortage. Once you get to that shortage, then what is the price of oil, right? It's like at that point, it's like if you need it, you need it. Whatever the price is, all right, give it to me, right? So again, these are the things, and that's why I think Europe is much more vulnerable to the situation than the U.S., and that's why Again, let's go back to this one. This one is WTI. Again, I have some positions on WTI as well, but I think it's much better to take the position on Brent. And another thing that helps that position is, like I said, that backwardation, that shape. Remember, it was like this. This shape actually helps to pick up some, because when you roll the contracts, for example, right now the contract is June or July or whatever. When you go to the next contract, because the shape of the curve is in backwardation, so you will actually get the at a lower price, the same contract, you can pick it up at a lower price. So when the prices adjust, let's say we are right, and this part of the curve actually starts moving up, then you can pick up those rolling. They call it the rolling premiums. So you get that one as well. And again, if take a look at these charts. Okay, you remember this? Up, down, up, down, up, down, up, down. Some of this up and down is not because, most of these big candles that you see, obviously there was a deal news or something, but some of this is not only because of the, some sort of a positive news, whether it comes to WTI, this one, or, or even this one. Again, you see the volatility, you see the up and down. Now, let's take a look at this. See how cleaner it is compared to, look at this one and this one. You see? This is the ETF, USO ETF, right? This ETF, you actually, you account for those rolls. The rolls that I was talking about that actually makes the position because of the backwardation you pick up, right? So you can see it here. That's why it looks cleaner, because those, whenever the roll happened and the price adjusted upwards again, you get that rolling thing, right? So however you want it. I mean, for me, I have some positions in the futures contract itself, and then when we get to the expiration, I roll it up, and then I roll it to the next month, and I can do that. But if you can't do that, you can even choose the ETF. The ETF actually does it for you. Obviously, they charge a management fee, but it's minimal, so you can use it. And this USO is for WTI. It tracks WTI futures, right? And then we have BNO, which is the same thing for WTI, but this is for Brent, right? So these are two ETFs. And again, you see how much cleaner it is than that one? And again, that's because of the backwardation. And one thing, if you are into energy, I don't know, during COVID, it was kind of the opposite, right? And now this is during the Corona thing. Even if you were buying the ETF, because the shape of the curve was in contango the other way, you would actually lose money on the rolling contracts. But right now we have a backwardation, so we can use this, and you can either do it yourself, buy the futures contract and then roll it up, roll it to the next month. Or you can, buy the ETF and they do it for you, but you actually pay, an ETF fee. So this is my understanding of the situation. And again, I do a lot of things with it. I just don't buy the I sometimes sell puts with using the options underneath the prices whenever the price drops, but you can do a few different things. If that's what whenever we talk about any scenario that we think is going to happen, we also have to think about what could actually ruin that strategy. What could go wrong, right? If you do not have two part of the plans in your head, then there is something wrong, because there is nothing that you can be 100% about. Okay, so whatever I'm saying, there has to be some sort of risk management to it. And now, what could go wrong? Now, the only thing that I think could go wrong, I mean, those when we talked about the Strait let me go back. We talked about the strait being narrow. They have to, the piece has to be in such a way that the ship owners and the insurance everybody's comfortable, everybody's happy, it can go back to normal. Otherwise, the infrastructure that is needed to bypass the Strait of Hormuz or everything else, those we know, it will take time, and so we talked about it. We have a flow problem. Okay. Now, the only thing that I can think of that, because we are going to buy the back month, like the September, December kind of thing, the only thing that could ruin and the price of oil would not go up, in my opinion, is that we have a recession, right? Meaning that the price of oil will go up, and on the other side, it will damage the economy and the purchasing power and the demand in such a way that the GDP would fall, and we will fall into a recession, thereby unemployment go up, and people are not going to consume as much oil, so there's not going to be enough demand, then the supply and demand will actually go into balance, right? So that's the only thing that I can think of, which is not, right now, I wouldn't give it a high probability. That's why I'm long oil. Otherwise, I wouldn't be. But it is a probability that I'm looking at. So while I'm long the oil contract, I am going to be very careful and focus on few economic reports from Europe, from America, from Asia, from the unemployment to GDP numbers to a lot of things to kind of see, are we damaging the demand or not? And we can see from the jet fuel prices, the airlines, tickets, a lot of things are actually, people are, although the airlines themselves, we had from Lufthansa that they have canceled many flights. And they have also laid out a lot of, lay off a lot of people. So they fired a lot of people. But and I also hear that a lot of people are like, oh, this is becoming too expensive. Oh, this is becoming, and soon we are going to have the World Cup, Football World Cup, and then we have summer, the driving season, everything. So it's hard to see. That's why I prefer to be long the backbone contract, because it's hard for me to see that the in this period of time, because again, summer is around the corner. So whatever happens in terms of recession, it's hard to see that it will be that damaging, that destroys all these travel plans, World Cup and all. But again, that's a probability. To me, that probability is low. But again, that's something that it's there. All right. Just wanted to know that, walk you through what I think and my understanding of today's oil markets. All right. Take care.